Hey everyone, welcome to Doc W Trades. It is Friday, April 17th, 2026, and we are taking a look here at the S&P 500 chart. And I am going to start out today by saying, whoa, 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 holy crap on a cracker. I have been trading for a little over 20 years, and I have never seen a rally in the general market like the one that I've seen over the past 2 weeks. Uh, Yesterday, I was just noodling and texting some trader friends of mine and actually asking them, when was the last time that you remember, we had this type of move to the upside? And just to put everything into perspective here, let's take a look at the S&P here, and we zoom in here and take a look at this move that we've had. And from the lows here, right around 63.53 on the S&P 500 futures, to where we are now at 71.58. Let's do the math, okay? Let's just do the math real quick. So here we are, 71.58. Okay, rounding off a little bit, but I think you guys get the point. And we got down to 63.53, close to 63.50. But 63.51, 63.52. But let's just take 71.58 minus 63.50. Let's round off. Okay, that's 808 points. It's an 808 point rally in basically 2 weeks on the S&P 500. And we take 808 divided by the original 63.50, and you have a 12.7% move. Okay? In 2 weeks on the S&P 500. 12.7%. To put that in perspective, a majority of the entire year's gains going back throughout history, back into the 1950s, even past that into the 1940s, all the way back to the beginning of the 20th century, a majority of the years, you don't have gains over 12.7% for the entire year. And we've had this move up like this, 12.8%, 12.7% in just 2 weeks. It's a massive move. And I was noodling on this with a few of my trader friends, and one said that we haven't had more than 10 consecutive up days, and I think now we're on day 12. Let's just double check. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 straight up days. We haven't had this many up days back to back to back to back to back to back like this in over I want to say 15, 16 years. Maybe more than that. I think the Great Financial Crisis was 18 years ago now. So the last time that we had 10 straight up days in a row was just after the Haynes bottom, which was on March 10th, 2009. So let's just zoom out here. Let's have some fun. We'll zoom out here, and we'll go to the max chart. I want to look at a daily max chart, but I have a max chart that goes back a long ways. on a weekly chart, but I'm gonna make a new time frame here. So press add time frame. We go back to the aggregation period is each bar is a day, and we'll go back. I'm going to go back 20 years, which will include the Great Financial Crisis in 2008. So I'm going to add that time frame here, and click apply, click OK, and then let's go here, and we're going to go to that 20-year daily chart. Now we can scroll back in time. We'll hop in a little time machine here. We'll go back in time, way back in time. Go back to 2011. We have 2013, 2012 here, 2011, 2010. Let's go back further in time. Oh, the Great Financial Crisis. As you can see here, we go all the way back to this 2007 to 2008 to 2009 time frame, and you can see this was the Great Financial Crisis. And right here, this big move down was in September of 2008. That's when Lehman went under, and then November of 2008, Obama was elected, and we just kept going down. And here, right here, we'd zoom in to this period here of March, April, May, June period of 2009. This was the Haynes bottom, and for anybody that's new, the Haynes bottom is called the Haynes bottom because the old newscaster, whose name is Mark Haynes, he was on Squawk Box, and then he moved to another show called Squawk on the Street on CNBC. And I loved him. I thought he was absolutely fantastic. He just was. He had a good sense of the market. He had a good sense of to sniff out BS. The newscasters we have today, the broadcasters that we have today, like Andrew Ross Sorkin, for example. I mean, the guy's like, he talks in riddles and is always asking these precarious questions and stuff. It's just. Mark Haynes was completely different. Mark Haynes was a lot like Joe Kernan, where you got down to the facts, he tested people, you called bullshit when someone was trying to, speak in riddles and in tongues and not speak the truth. And so Mark Haynes was on in the morning on Squawk Box and then Squawk on the Street. So he was actually on with Erin Burnett. And Erin Burnett was, 18 years younger, 18, 20 years younger back then. So she was much sexier than she is now. And, now she's on CNN, so she went to the left and she's super liberal. But, anyways, he came out on March 10th, 2009, after the market's just been going down straight, and he said, I'm going to go out on a limb here. He goes, I think this is the bottom. And he came out, so that's March 9th right there. And the absolute bottom was March 6th, and he came out that day after, I think. The absolute low was March 6th, and he came out on March 9th or March 10th that basically said that was the low. That is the low. That is the bottom. We're not going any lower than that. And from that point, the market just has gone higher ever since for 18 years now. So that's why they call it the Haynes bottom. Mark Haynes passed away a couple years later in 2011. He had a heart attack, and I miss him a lot. I wish he was still on. I wish he was still around on CNBC. We're losing those good old school journalists that weren't trying to push this liberal agenda that we have today. So that was the Haynes bottom. And as you can see here, we had many, many consecutive up days. I think this red bar here, even though it's a red bar on my charts, that was an up day, obviously. Then a second update, third, fourth, fifth, sixth, seventh, eighth. So we had 8 days up, and then had a down day, and then we're up again, and then a down day. So I think the record, that was 8 days in a row that we were up like this. Now, in my mind, I think it seems like we could have had multiple up days like we've just experienced coming out of the COVID crash. So let's zoom back out here and let's go forward in time. So we were in March of 2009. Let's hop in our time machine and go forward in time. And we're going to go a little more forward in time here. And we're going to go to, let's go back in time. We went a little too fast into the future. Let's go back into the past to 2020. And as you can see here, we have the COVID crash that many of the newer Robinhood traders, as I call you guys, have experienced. And you have experience with this crash of the COVID crash and then the subsequent bounce higher. We zoom in here. We bottomed right here on the 23rd of March in 2020. And from there, we had an up day. That's 1 day, 2 days. We had an up day, 3 days in a row. But then we had a down day, then we had an up day, and a down day. So we still didn't get like a rush of consecutive up days. We had an up day, then a down day, then an up day, up day, up day, up day. So that's what I was thinking. I was thinking of previous times when we had these bounces off the lows and we formed the bottoms. We really haven't seen 13 or 12 or 13 up days in a row like we're experiencing right now. This move is vicious, and so I'm doing my research right now, and looking at the bottom of 2009, looking at the bottom of 2020, and you didn't get more than 8 consecutive up days. So, I think today's 12 or 13 days in a row up. So this is a record. All that being said, let's take a look at what can cause it. What caused this type of reversal like we're experiencing. And I want to point out something before I move on here. And let's see here. I'm on another screen here. I'm just gonna do something here. Hold on. And before I move on, I'm actually going to delete that time frame on the charts. Let me just clean this up here. Let me just delete this time frame. I can always add it later. And let's take a look at this. I want to show you guys this. So this is a chart that I have. And as you can see here, we have the SPX. That's the S&P 500. This is the SPX, the actual index that does not trade. This is the underlying S&P 500 index that does not trade. It's the basic index as a whole. You cannot trade this index. Everything else, the S&P futures, the micro futures, SPX options, SPY options, everything, they're all based on this SPX product. That's what they call it, the mother of all products, even though it doesn't actually trade. As you can see here, it has a bid and an ask, but you see it doesn't actually trade. And you can go back to the trade tab, look at the SPX. Let's type in the SPX here, and go to the trade tab on the SPX, and pull up the options chain here. But you see how there's no volume. See, there's no volume, there's no size. Now these options trade based on the SPX, and those options for the SPX actually trade on the floor again. They didn't used to trade on the floor for many, many years, but they opened up a new trading floor in Chicago. And if you've seen the new trading floor at the Chicago Board of Options Exchange, they have traders on the floor. Those traders are trading the SPX options and the VIX options. So they opened up a new trading floor, and they have those traders on the floor trading SPX options and VIX options. If you go online and go to on the YouTube page or the website Tasty Live, they broadcast a lot from the options floor where they trade SPX options and VIX options. And just SPX options and VIX options trade at the CBOE now, the Chicago Board of Options Exchange. So you see here, the SPX itself doesn't trade. No volume, no size, just the last price. And I think they get that price by it's just what the index is of all the underlying 500 stocks. So that is how it is. And everything else is pegged to that. So let's go back and take a look at this SPX chart. This is a candlestick chart. And you see here, what sticks out are these lines. And what these lines are the expected move for the entire week. So you see here, this middle line here is where we start the week, and then the lower line is the lower edge of the expected move. The upper line is the upper edge of the expected move, and you see the expected move for each week here, week by week by week. When you see these light blue bars, that is when you close the week and traded above the expected move. So what you see here is for the past 2 weeks, we have traded above the expected move. And again, this week we've traded way past the expected move. And this red bar here is actually an up day, but it closed below the opening price, so that's why it's red. But we have, the bottom here that we had on March 30th, and then that started the extended run higher that we've been experiencing. And this is a bona fide extended run as the SPX has just ripped higher, and the fact that we have traded above the expected move has created, in my opinion, a gamma squeeze for the market. And basically what that means is, as the market has traded above the expected move, is it has created kind of a feedback loop where we have traded higher to a point where more options have to be bought because the market has moved to a certain point beyond the expected move. And once it moves beyond an expected move for the week, it creates that feedback loop where market makers have to buy more options and continue to hedge, and it just creates that more and more buying. So what happens is the options that people that are being bought force the market makers to have to hedge by buying more options, and that specifically the SPX, because they can't buy the underlying SPX because it doesn't trade, so they have to hedge those options that are being bought, but buying more options, which creates the options that were bought earlier to go up in price more, and it creates that feedback loop. And we experienced that a little bit here 2 weeks ago, right after the bounce. But then again, last week, we had 3 days of last week that were above the expected move here. And so that gamma squeeze, as they call it, kicked in. And then again this week, on Tuesday, we were back above the expected move, and that gamma squeeze kicked in again this week, where they have to buy more options, which causes them to have to buy more options. So that dynamic of the change of the options that forces market makers to have to buy more options is called a gamma squeeze. And as I said, you can't just hedge off the options that are being bought by buying the SPX, because the SPX doesn't trade. You have to buy more options further out of the money, and you have to do other things like buy the SPY shares, buy the S&P futures contracts, and so on and so forth. But those are other ways to hedge. But for the SPX, it's just it creates that feedback loop of buying more out of the money options, which makes the options that are bought go higher and higher and higher, and then the index just goes up more and more and more. Now, many years ago, when they introduced weekly options, we were seeing gamma squeezes in individual stocks, and most of the time, the general market, yes, S&P 500, stays within the expected move. But just recently, since the bottom, we have gone back to back weeks trading above the expected move, which creates that gamma squeeze. And gamma is the Greek letter that is the rate of change of delta. And that is basically the dynamic that forces the market makers to have to buy more options, because we'll go here and take a look at the SPX options, and you can see here, as we look at all these options here in the SPX, we have to keep scrolling more, scroll, because there's so many strikes. As you see here, you have the options, the in-the-money options, the out-of-the-money options for the calls, out-of-the-money puts, in-the-money puts, and the at-the-money options here, right where the SPX is at. Just to the left, you see the delta, and you see the delta just to the right here on the puts. So delta, at its simplest form, is basically the equivalent amount of shares that option is, and it's the rate of change. It's the rate of change of the underlying option. So the at-the-money options are 50 delta. The in-the-money options are closer to a full 100 delta. And then the out-of-the-money options, you see, looking at the puts here, go to 0. We look at the calls. The in-the-money calls are close to 100. The out-of-the-money calls go close to 0. So what happens is, as the SPX, it goes up, the out-of-the-money options that are just could be an 18 delta or 16 delta, 13 delta, 11 delta. As the SPX goes up, those options become a 50 delta. Then it goes up more, and they become a 70 delta, and then an 85 delta. And that rate of change going from, say, 16 or 13 delta to then becoming a 30 delta, then becoming a 50 delta, then becoming a 70 delta, then becoming an 85 delta or a 90 delta, that increase in delta, the dynamic of increasing the delta, which is gamma, causes the market maker to have to hedge more and more because it's just increasing exponentially. And I think that is what's been going on over the past 3 weeks. And the fact that we are now trading zero DTE options, basically, where you have 0 days left to expiration. We can take a look at all these zero DTEs that expire in the next 30 minutes as we go towards the closing bell. We take a look at all these options. The fact that these options are expiring, within a day. In this case, these options are expiring in just a little over 30 minutes. Those deltas change faster, and the rate of those deltas changing is faster and faster and faster now. That dynamic, which is gamma, the rate of the change of delta. So the delta is the rate of the change of the underlying. The gamma is the rate of the change of the delta. That dynamic there is causing market makers to have to hedge more and more and more by buying more SPY shares, by buying S&P futures, by buying more out of the money calls. Is creating that feedback loop, that snowball effect, which has basically caused the S&P to go up so fast. And the correlation between the S&P and the NASDAQ and the other indices like the Russell, they're all kind of all together creating that big snowball effect. And then it's kind of passed on into the other individual stocks, and they're moving up higher as well. So this dynamic of the zero DTEs that we now live in, this world that we live in with zero DTE options, I think has a huge effect on how fast and vicious this rip your face off rally has become. And that's the world that we live in. Because if you think about it, and you zoom out a little bit here, let's go back to the chart tab and take a look at the SPX. And we go back and we look back, on a daily chart. Let's look at a weekly chart here. We'll go back 5 years, okay? And we look at the SPX. We can look at the S&P futures instead or whatever. It doesn't really matter. But you look at these big down moves that we've had, these big sell-offs that affect us all, especially if we're bulls. We had a big sell-off in 2022. We had the next big sell-off was the tariff tantrum Liberation Day in last year, the beginning of 2025. And now we traded in a sideways range and then rolled over with the start of the Iran war. You notice how on each pullback, going back all the way to 2022, each real sell-off, we had a little bit of a sell-off here in 2023. Each down move, each sell-off, the bounce back has become more and more vicious. And I don't know this for sure. I haven't seen any research or white papers or any empirical data that's based off of all this. But to me, I think the zero DTE options are having an effect on both the down move, because it's faster to the downside. Look at the down move back in 2022, and then look at the down move in Liberation Day, and then look at this down move with the war in Iran. It's faster, but then the bounce back is even faster. So I guess that's the world that we live in. And I was listening to someone, and they were kind of, it's a gamma squeeze. It's these zero DTE options that are making the market move so fast. And this person's bearish, and he kind of just goes, I hate this. This sucks. I'm like, well, why don't you adapt to it? That's what I was thinking that when I was listening to him talk. I was like, Why don't you adapt to it? Okay? The market is an ever evolving organism in my mind. You know, this it's a complex system because you have all these factors, all this stuff going on, all these different market participants. It's affected by ongoing changes in the world and everything. And it essentially is, if you speak to a quant, it's a complex system. You know, why don't you have to adapt to it. So if that is the case, okay, and we're getting more and more vicious moves and the velocity of the moves are increasing because of the zero DTEs, why don't you just adapt to it? And going forward, you know, learn from everything that happens. The next time that we get a big sell-off, make sure that you do your buying, okay? And commit your cash to it, to stocks and stuff, and be ready for a vicious up move like we're having today over the past 2 weeks. So that is my opinion. I was, you know, for quite some time, my model of the markets was basically that. Let's go to the S&P 500. I like this chart better. Let's go to the daily. My model for the markets for quite some time over the past couple months has been, we'll go to a daily chart of the past year. It has been that we have been in a sideways trading range. And that sideways trading range, as I've mentioned multiple times, started right here towards the end of September and has continued all the way to the end of March now. And I was looking for a rip your face off rally at this point at the end of March. Okay? I was looking for an oversold bounce in the market. However, I was not looking for the market at this point, towards the end of March. I was not looking for the market to go back and test all-time highs and then break out and make new all-time highs. So my thesis, my model in my mind of what I was looking for the market to do for at least into the summer of 2026 and towards the rest of 2026 was not what was happening over the past 2 or 3 weeks. For the most part, going into the end of 2025, I was like, okay, we've had a huge run to the upside. Okay, liquidity, money flow conditions are kind of drying up. I've mentioned the work from Michael Howe about, he's from Cross Border Capital, and he was saying how, you know, the liquidity is kind of drying up and there's a cycle with liquidity and we are due for a dry up in liquidity and less liquidity in the system because there's lots of debt that needs to be refinanced and there's a cycle to this, and the next couple months to a year should be a more bearish atmosphere for stocks. And I was looking for that to be the basis of the market action for 2026. So as we finished up 2025 and began 2026, it was in conjunction with that view that money flows were drying up and we would be trading in a sideways, choppy to slightly bearish at least market. And the up move that we had over the past couple years was ending, and we needed to have some type of choppy, sideways, bearish type of action. His work You can find him on Substack. He's got a lot of videos on YouTube and so forth. Basically said that right at the end of 2022, so throughout 2022, his work said that liquidity was coming out of the system. And he said that right around October 2022 that liquidity bottomed and money flows were coming into the market. And this cycle lasts about, 4.5 years, and you have 3 years up, and then we were due for a down year to choppy sideways action in 2026. So everything lined up with his case. Everything seemed very, very good. It's like, okay, so the end of one liquidity cycle was in 2022, the beginning of a new one. We went up for 3 years, and now we would have some sideways action and maybe some downside bearish action. All that being said, the market action over the past 2-3 weeks have completely wrong chart here, have completely thrown his thesis up in the air. I mean, it's crazy. I don't know. I'm like, we have now, if we stayed within this sideways trading range, that tape action would meet with what he was saying. There's a dry up in liquidity, we're in a trading range. But the fact that we have rallied like this viciously, and we have broken out to new highs, kind of puts into question everything that he was saying. And then you think to yourself, maybe nobody has a clue what's going on, myself included. Because, we bounced like this, we had an extended run, and we had a bullish engulfing bar here, and now we've made new highs, and we've done so, and I'll show you in a little bit, with new momentum highs. It just throws everything that Michael Howell was saying kind of into question. So if we continue here and look at the S&P futures here, and we look at this chart with Bollinger Bands. This is a daily chart over the past couple of years. This is a weekly chart. Maximize this chart and we'll zoom in. But we look at this move in the S&P. We see how we went from the lower Bollinger Band up to the upper Bollinger Band, but then the upper Bollinger Band expands to the upside, which is indicative of a gamma squeeze, because as the Bollinger Bands expand, volatility expands, and it pushes that, the S&P pushes that Bollinger Band higher and higher and higher as it goes higher. That's an extended run, and it's a gamma squeeze, and essentially they're kind of the same thing, specifically when it moves to the upside. And we're going to zoom in here a little bit, take a look at the S&Ps, take a look how it keeps running up as the Bollinger Band, the upper Bollinger Band expands to the upside. So that upper Bollinger Band is expanding as volatility to the upside increases, and that volatility increase is aligned with the gamma squeeze because they're buying those options as the S&P is going up, and as that snowball effect kicks in, they're buying, the market makers and market participants are buying those options, and that increases volatility, because as options go up in value, that's volatility going up in value because the expected move is increasing. So that the fact that the S&P is at the upper Bollinger Band, that's an extended run, and then as the upper Bollinger Band expands like it has, that's the snowball effect of a gamma squeeze kicking in, and it's just kind of feeding on itself. So all that happened. We zoom out here, and then we take a look at the rate of change oscillator that I like to look at, and then the 310 oscillator, the fast line of the 310 oscillator. Both of these have gone up to new highs. I think, there's only a couple times in the past where you get these momentum spikes up like this. We got it here in you got it here in 2023. We have it here in the Liberation Day sell-off. That spike in momentum after the bottom was a little higher than where we are here, with the bottom here from the Iran war. And when you get these spikes in momentum off the bottom, the model says, the data shows that you continue to go higher. And what will happen is when you get a reaction down at some point, whenever that is, the oscillators will come down a little bit, but then that sets up for another push higher in the oscillators and in the indices. So it makes sense now that we have these upthrust in momentum at recent highs and historically very close to highs, and all-time highs for the fast line going back all the way for the past 3 years, but very high levels in momentum. That is basically saying that this uptrend can last for a while. And as you see here, in the past, we'll go back to 2025, you get this upthrust in momentum, right? And the rate of change in the fast line, and even the slow line turns up as well. It just takes longer. The market continues to go up, even as you don't get high levels. You get kind of divergences in momentum in the fast line. But after that initial upthrust, the indices continue to go up, and then they make new highs in this case for a while before the momentum kind of cools off and the uptrend runs out of momentum. So the data shows that yes, we were bound to make new highs, and momentum making new highs the way it has shows that this up move will continue for foreseeable future. So you have the model of momentum and tape action, price action, showing that we can continue to go higher. However, you have what I've learned from the liquidity model. Now these two models are kind of they're not matching each other. And the other thing that I found out was that, first off, momentum precedes price. That is a underlying technical rule that has been around for decades. That was written by Charles Dow in the early 20th century. But one thing I've been thinking about is that liquidity and money flows and momentum are kind of like one and the same thing. So momentum because money flows create the supply and demand that moves stocks and all tradable products up and down. So when you see the increase in momentum like we have here, and I'm going to zoom in so you can see it a little better. You see this increase in momentum. It also means that you have an increase in liquidity and an increase in money flows that is pushing the supply and demand, up, pushing that demand up to create the price action to go higher. So it's all kind of in symmetry with each other, whether it's liquidity, money flows, momentum, so on and so forth. It's all basically different ways of saying, price needs to go higher. I'm going to personally do some more research to find out what's going on. I think that even though, Michael Howell was looking for money flows and liquidity to decrease because of the situation that we're in with everything going on with the war and so forth, we may have had an instance over the past 2 or 3 weeks where liquidity just came into the marketplace that was unexpected. And I think that's very possible. There was an article on Zero Hedge that discussed CTAs, commodity trading advisors, and they're a type of funds that use algorithms and so forth to buy and sell stocks and other commodities and so forth. And this article said that over the past, it's a couple days old now, but it said over the past 2 weeks, CTAs have been buying over 68 or 86 billion dollars worth of stock, which is liquidity, which is momentum. As they are the liquidity, and as they buy these stocks, that pushes the momentum higher and pushes price higher. And the article said that they are still showing that they need to buy like over $70 billion worth of stock, and they still haven't finished doing that yet. And that may be a outlier event that we're seeing now that kind of was the spark that lit the match that created this gamma squeeze. So if you have funds that are coming in buying $86 billion of stock and then another $70 billion of stock, that is going to create feedback loop where then there's buying of zero DTE options, and then the market makers have to hedge and buy more options, and so on and so forth. And that created the gamma squeeze that we're seeing. So if there is an anomaly where we had a rush of liquidity that also pushed the momentum higher and pushed the market higher, I'm going to look into that because I think that's very possible. And I think because of the overarching macro view of the situation that we were in going back to the end of March, the war and a threat of nuclear war, and Trump saying that he's going to annihilate civilization and so on and so forth, that may have pushed a lot of fund managers, specifically CTAs, to short the market heavily. And another thing that could have contributed to that is the way the chart's kind of set up. I'm going to zoom out and then zoom back in here. And what's interesting is we were trading in this sideways range for quite some time, multiple months. And we can go back to here, the end of September, beginning of October, and you start to see this sideways trading range that I've talked so much about over the past couple months. And we formed solid support right here, right at the 66.20, call it 66.30 level. And I'm going to get out my trusty drawing tools, and I'm going to draw a sideways line here, and right here And this was really when the sideways range began after the sell-off on October 10th. And you can draw a sideways line here and really form key support, because we then tested that low here on November 21st. And depending how thick your line is, that's two data points here, one here and one here, that basically cement the support. And what happened was we broke that support here right in the middle of March, or towards the end of March. And that technical fact, because CTAs are very technical oriented. They're trend followers, the momentum followers, and they're technically oriented. They don't look at fundamentals and stuff. The fact that you had all this stuff going on in the macro world, and we broke this key support, we're like, okay, we're in a sideways range. Towards the middle of March, it's like, okay, it's bad, but we're still holding that support. We broke that support here, had a reaction to it, and then follow through to the downside. That fact that we broke that support and then had follow through to the downside could have caused these funds that are CTA oriented to short everything, looking for more follow through to the downside. We got some news on the Strait of Hormuz that they're working a deal and they're not going to actually blow up the world, and you get some initial short covering, not just from CTAs but other fund managers too, because you probably had a lot of RIA type of investors, the funds that are RIAs, which are registered investment advisors. These are the people that manage money for very wealthy individuals and so forth. So you got to think of all the market participants out there. You have the CTAs that are shorting as we break support. Then you have some guys that are, trying to calm their clients because their rich clients are losing money, and they're like, you know what? Let's just nibble and buy some of the Mag 7 because they are now much cheaper than they were, for the past 6 months. So let's nibble. Let's buy some Nvidia. Let's buy some Amazon. Let's buy some Apple. Let's buy some Meta, because they're thinking long term. The CTAs are thinking more short term from a technical standpoint. The RIAs are thinking, okay, now's a good time to nibble and buy some high quality stocks for our customers. So they're talking to the customer saying, calm down, everything's okay, but we're going to take some cash and buy some stocks, because long term everything will be okay. And you have a combination of funds buying stocks, then you have the CTAs have to cover their shorts very quickly, and you have positive news. And in today's world, we actually have retail investors that are so bullish because they are used to every dip getting bought. They're buying stocks and buying options too. That pushes the market even further higher. And then the zero DTE hedging comes in and creates this gamma squeeze, and now we have traded up to new highs, and here we are today. So that dynamic of the shorting, the aggressive shorting to the downside, with the news coming in being positive, in addition to people just buying an oversold market, that situation, and then on top of that, the zero DTE options created this gamma squeeze to the upside. And it just goes to show, let's use this as an educational opportunity. The next time we get a market that sells off for whatever reason, at a certain point, you get some good news or something happens that's positive, it's going to create another gamma squeeze, and you're going to have to buy as it's coming down before this happens. especially if you're a retail investor. You have to take that longer term approach and be ready to buy any dip, because you know all these funds have different objectives and they're very competitive, and they're going to move the market. And if you can just be ready and calm and cool and collective to buy when you have some type of sell-off, everything will be okay, because the world only ends once. And it's been around for over 4.5 billion years or something. The odds that the world's going to end before I die, I think that's pretty low. And I know many people are saying they're going to want to live forever and go into become machines and go to the moon or Mars. Not me. Okay, I'm living on Earth. I'm not going to Mars. I'm not going to the moon. And I am going to live here. And if there comes a time where I'm going to have to choose whether I live on Mars or the moon or some spacecraft, or live forever as a machine, at that point, I'm just going to die and go to heaven. That's my best option. If there's a point where I can't live on Earth anymore, I'd rather just go to heaven. So that's my take on everything. So going forward, we've made new highs. The momentum is at highs. And we don't just have momentum highs in the fast line and the rate of change, but the slow line has now gone positive and is now trending up. So the model says that this move can continue. So all that being said, my overall model for 2026 has been completely obliterated. Okay, I thought I was looking for chop sideways action. I was looking for the market to stay in a sideways trading range up to this week. That was all playing out the way I expected, but this move has blown that out of the water, and I am wrong. We're at new highs, momentum's at highs, we're in an extended run, and at this point going forward, the model says that we can keep going higher. Even if we look at a longer term chart, let's go to the weeklies, the weekly chart. Let me zoom in here. We see this upthrust in momentum. Look at that. You have this big momentum thrust in a weekly chart. That's very bullish. And the odds are that now that the slow line on the weekly chart has gone negative and is turning positive, along with the momentum thrust in the fast line, the game plan is from this point that, okay, now we've hit the upper Bollinger Band. So some type of reactionary sell-off is overdue. And that is the closing bell. Some type of reaction is overdue. Okay, it doesn't take a rocket science to figure out that we're short-term overbought and we need some type of reaction to the downside. But that being said, any reaction to the downside from testing the upper Bollinger Bands, having the momentum spike like this to the upside, needs to be bought, because what's most likely at this point is that this slow line gets back above positive as it's turning up. We're looking for that to get back to the positive territory on the 310 oscillator. It went down to negative and now it's turning up. I was looking for it to go further down and get down to say under 100, but at this point it doesn't look like that's going to happen because of the way we had this upthrust in momentum. What's most likely is this upthrust in momentum at some point has a reaction down, but then makes another move up at some point. So, it makes sense that you have some type of move down and then in the oscillators, and then they go back up. and you really can't consider some type of, it's very advantageous if you look for some to short this type of market with momentum making all-time highs like it is at this point. So my playbook right now is basically throwing out the whole sideways range chop action for the whole year at this point. Will it come into play in the future? Could we get some type of rollover back and forth type of market action later this year? I don't know. But the way you have these new momentum highs and you have this upthrust in momentum precedes price. So I'm in the camp that you just have to stay with the trend of the market. You're at all-time highs, you have an extended run, you have momentum highs. This slow line is now turning up, so it's due to get back into the positive. So we got to keep going up until at least this gets up into the positive, and we'll take it from there. So it looks like this corrective phase that we've been in since October, say, has come to an end, and we're getting this massive buying spree in stocks. And it's very advantageous if you try to step in front of a freight train to try and look to short this market. At least have some type of divergence form or some type of double top or some type of formation that shows that the momentum is rolling over and the market's running out of steam. Because usually when a market peaks, the oscillators will show you that momentum is coming out of the market. That's what happened here. In September, October, the momentum was rolling over. Okay. And there's an old saying in the market that tops form and bottoms happen, and it looks here like the bottom has happened. We even went all the way down to the lower Bollinger Band. We were going back and forth in this sideways trade range, and once we got to the lower Bollinger Band on the S&P 500, then we bottomed, and now we're back up to the top of the Bollinger Band. But because tops form and bottoms happen, just because you get up to the upper Bollinger Band, that doesn't mean that it's going to top. It just means that you're probably due for some type of reaction that will be bought, especially if momentum is making highs like it is. So with all that said, the best playbook to go forward is be ready to buy the dip. Basically, be ready to buy the dip, expect a dip, and be ready to buy the dip. I was looking for more sideways range days this week, but we had 4 days this week that were trend days, including today. That's just insane. 4 trend days in 1 week. That's absolutely crazy. So going forward, I am looking for some down days and some sideways range days that allow the market to consolidate this big move higher. And as that happens, momentum will kind of come down and set up for the next boom move higher. So going forward, be ready to buy the dip, and don't short this market. Don't try to stop a freight train. With all that said, I'm going to sign off, and everyone have a wonderful weekend. Take care, and bye.